Welcome to the Invest with Rules Trends with Friends. I'm so happy you're all here. What a fun and wild January it's been. We have a big agenda. Mike, are you ready to dive in? All right. So before we dive in, quickest disclosure. So this is just information. It is not a direct solicitation to go buy or sell anything. Please always manage your risk, manage your rules. There's risk out there, even though sometimes the last couple of weeks the precious metals haven't shown it, but at some point they likely will. That's the fun disclosure. And then our process, what are we doing? Why do we do it? Our belief system, we follow the trend. We follow big money. We follow a lot of risk management rules. Thank you so much for being a member. This is Invest with Rules. If you have questions, we'll try to answer them here. Hello at investwithrules.com. Our totally separate entity that we may reference once or twice just from a holdings perspective. We have it's called IWR, Invest with Rules Advisors, where we do deep financial planning and we have three investment strategies. So if you have check out IWR Advisors, if that's something down the road, if you're ever not self-directed. If you're self-directed, fantastic. We want you to do it yourself. We just want to make sure that you do it with rules and you don't have very large losses. I'm going to start today. I saw this at the end of last year. This was the Vanguard released their 2026 Economic Market Outlook. And I thought it was really interesting. And I want to share how I think through articles like this, because I think we all, whether it comes from large financial institutions, or it comes from your friend, or it comes from CNBC or Fox Business, it's like, how do you filter this? So the Vanguard released their study, and I'll put this deck in the members area in the market update this link at the bottom to this exact article. But the first thing that they share are some thoughts and then ideas for 2026. But this was I thought was really interesting. So the first thing they said was in regards to AI, they're giving their probability analysis on AI in 2026. So scenario one was AI's transformation is stronger than expected. It's going to be another booming AI year. They pegged it at 10%. They think that AI emerges as general purpose technology that generates 3% trend for US growth. They peg that at 60%. And then AI, the kind of the fear that everyone kind of talks about on the media because it grabs headlines is AI is going to pop, it's going to bubble and pop and disappoint. They pegged it at 30%. Mike, before we internalize this further, any comments or thoughts?
Yeah, it's fascinating. I think even in the span since this was put out a little bit over a month ago, I think things are changing so quickly in AI space. Yeah, but I guess my gut is, Scott, that AI is going to have a bigger impact. It's already having impact on what we do, our industry, so many industries. And in fact, I heard a quick little anecdote that at the World Economic Forum that just wrapped up in Davos, that apparently, besides all the global things going on, AI was the biggest topic outside of global geopolitical things. So I don't know. We'll see.
Okay. So how do we internalize this now? I think that's super interesting. So we apply it to our trend roadmap. Trend roadmap is a technical analysis tool that we use with our billion-dollar fund manager analysis. We use it with ETFs. And we have four stages, and we mathematically put things into these buckets. So there's a short-term trend, a long-term trend, and we can codify it, which is what we want to do. So if I were to look at a chart of the NASDAQ 100, and don't get me wrong, there's a lot of tentacles of AI there's the data centers, there's robots and machine learning and everything. But with the QQQ is the biggest behemoth spending the most on AI. And I think what's really interesting is this has been not your leader. This has been kind of chopping sideways, having some moments of doubt, but it isn't a short-term and long-term uptrend. So the NASDAQ 100, if I were to draw with my eyes, it looks like a wedging pattern. And who knows? We don't really know. We react. Will it break up to the upside or downside? We still have a half position in the NASDAQ 100. The thing I would also add, just so you're seeing this, we use our Google Sheets trend roadmap ticker tool for now. We are at the final testing phases of our trading view indicator of the trend roadmap. So when that is available, we'll absolutely give it to you. We have a few more tests and bugs to kind of finish. But I think this is pretty interesting. So it's definitely not defined. I would like to see it break up and out. Probability wise, I wouldn't put it in the bubble category at all at this point. Okay, now what does Vanguard like? They are a behemoth of capital. So we've seen the world go from active management to passive management, ETFs, mutual funds that are indexes, and we are firm believers in low cost ETFs. So we either do stocks or ETFs. We don't do mutual funds that are actively run, but we want to take advantage of the flows because we follow trends. So, three things that Vanguard likes. So, the first thing, I'm going to start at the bottom. The headline grabber of this article was that US stocks, which have been the best house on the block for, call it 20 years, they're expecting a 10-year return expectation of 4 to 5%, so far less than average. They're expecting non-US stocks to outperform, and they're expecting bonds to perform 3.8 to 4.8, so in line. So what are they telling their clients? They like high quality fixed income, meaning investment grade, triple B and above, corporate and government debt. Number two, they like value oriented stocks. So not growth, but value. And number three, they like non-US developed market equities based on lower valuations. So if you've noticed our Invest with Rules model portfolio, we don't have fixed income. It doesn't deserve our attention yet. Maybe one day it will, but we definitely have a lot of value. So we have a lot of stuff, not growth tech, and we have a lot of international. So let's go through the trend roadmap. What's it telling us? So this is one of the Vanguard Behemoth ETFs, BND, the Total Bond Index. The green line, just for grins, is the 21-day exponential moving average. The red line is the 50-day simple. The black line is the 200-day simple moving average. And then you have our signals. It's on a gas signal. So we like what Vanguard's saying. In full and fair disclosure, we liked it a lot more at the end of 2023 because 2024 was fine. 2025, it's been even better. And now we're into 2026. So the trend really kicked off a long time ago, but hey, why not? So before I move to the next ticker, Mike, any thoughts?
Yeah, I think that you got to put this in perspective though, because even you go back to that late 23 gas signal to today, it's had some, especially considering the yield, it's had some good growth, but nothing compared to equities.
Yeah, that's a fair statement. Speaking of that, Mike, why don't you cover the value Vanguard Value ETF, which is in our ETF ranking model, VTV. What stands out to you?
It's continuing to chug ahead. Had a little bit of a slowdown in November into December with that latest coast, but it's been all green since then. It's carrying up that 21 that you pointed out, the green line. So arguably extended. Although, and by the way, did we talk about the green triangles and orange squares?
No, do you want to cover it?
Yeah, so the orange squares indicate an overheat. And so VTV recently came off an overheat. So it's doing a little consolidation. And then the green triangles, that's our kind of added confirmation. We've got some things in our algorithm to say, hey, added confirmation that this thing is setting up, it's in a gas and setting up even better for potential moves.
And I would say that nothing's perfect. There's no
Yeah.
holy grail indicator. You'll see green arrows and it's been working, green triangles, and then boom, and then it resurfaces. And there are times where overheat stays overheated for a very long time, and that's a relative strength index over 68. That's what we follow. If you wanted to use 70 or anything different, that's by all means. And we track a ton of ETFs, about 90 of them. But here's VEA, which is specifically developed international markets. And I want to share this one because this is the Vanguard article to a T. And this is last year. You would have gotten the trigger similar to the US market in April, and it just keeps chugging along. And you got a bunch of overheat signals since the last gas, which was at the end of November. This is where the money's flowing. I hope that's helpful. So when I see article, I put it through the filter. That's how we do it. So this is some third-party research. Charlie Bellel, he's on Twitter everywhere. So last year, who was the best place to go overseas? European stocks up 36%. Emerging market stocks up 34%, and our hometown turf 17.9 for the US, the S&P 500. So how do we interpret this? Is one more Charlie document. It's an eye chart. But what happens is international can outperform for several years, even though we don't remember it because it hasn't happened in a very long time. So what we're looking at is the years in the year column, the S&P 500, the MSCI World Index, and then the differential. So last year you would have been better served having international, which happily we had a lot of it. The year before that, you would have much rather had US stocks for 2 years in a row. 2022 was a slight differential. It lost less being international. But I remember like my some of my there was like early 2000s where international had a really big run. So anything that you see in this kind of pink color is where the world return outperforms the US return. So even though it's hard to remember, 2002, 2003, 2004, 2005, 2006 was a constant international outperformance. So even though it's hard to remember, it may have just started. So an interesting phenomenon. And then last but not least, so far in 2026, the king of the castle, which we actually added more to this morning, small cap US, Russell 2000. Emerging markets, mid cap US, developed international, real estate, then finally you get large cap value, equal weighted. Again, this was as of the 20th, so we're now at the 23rd. And then you get the SPY, large cap growth, Mag 7. So you're seeing the rotation. This is from, again, third party information. But I wanted to share this with you. Mike, let's wrap up this segment and we'll open it to some questions. We'll go through the markets. Anything else stand out to you? And as we take information in, we filter it, and it's saying, hey, pay attention international.
Yeah, it's. I think their overall assessment is very interesting for what's going to be coming in the next, let's call it decade. Go back to the eye chart for a quick second, because I think something super interesting is from 2002 to basically six, that spell of pink where international was outperformed. And that's during the lost decade, the last lost decade, where from what, roughly '01 to 11, the S&P went nowhere. The US markets went nowhere in that period, gyrated obviously, but went nowhere overall. So I think that's very interesting. Does this past year kind of lead to something similar? We just don't know. We shall see.
I'm going to go in the members area of Invest with Rules, and let's go to market health. Can you see what I'm seeing now?
Yep.
Why don't you kick us off?
Yeah, let's hit the gauges first, and then I'll flip it back to you for the sector strength. So stock market score is a 9. I think it got as low as an 8 this week and hit a 10 at one point, but it's at a 9. Our percent invested remains just about 100% with the latest moves this morning where we essentially closed out Dollar Tree and filled out the rest of our small caps, as Scott mentioned. That puts us at almost 100%. Our beta, because of our heavy exposure to materials, precious metals, etc., is below 1, meaning that we're not moving necessarily like the market per se, and you see that and what's going on. And portfolio heat is a -10, so we're pegging the portfolio heat gauge. Now, what is that? Just in case you don't know, if you're newer, that basically means if all of our, let's say over the next day or so, if all of our stops, our trailing stops got hit on all of our model portfolio positions, would be down roughly 10%. Now, that may seem like a lot, and I've talked about in the past where that is a lot. We like to keep it out of the red. However, considering what's been happening in January with the mall portfolio, it's not actually unusual, even though it seems that way. The mall portfolio, as of us recording this, is up over 17%. Is that a tell of what's to come? We just don't know. And please, we can't expect this kind of performance going forward. But that leads to that portfolio heat score of around 10%. So what's going to happen as things, let's call it normalize, I think you'll see the portfolio heat pulling in. Scott, any thoughts to that or the sector gauges?
I think you covered it well. So, off to the far right over the past 14 days is relative strength, relative weakness to the left. So, gold, no surprise, is having another huge run. I'm actually a little surprised that it went up the last 2 days.
Yeah.
Given
Yeah.
just now you're at relative strength index of 79, approaching 80, and then we have a mechanism to sell into strength on extremes, but we're just not there yet. Materials and gold and energy and staples are now over 68. So that's pretty interesting. The small caps having a down day after so far a great start to the year. So we'll pick some up on the down day on a gas signal. We still have our confirmations. And there's international. So interesting. This is the article I wanted to share because it's spelling true at the moment. International, I would say value, but bonds aren't going to be in here. That's not that exciting. Off to the far left, you have financials, utilities, and Bitcoin. Bitcoin is the only major asset class that's on a break. As much as it's up a little teeny bit today, not so great. And then down below, the largest holdings of the S&P 500, ExxonMobil on an overheat. Google, which is standing out a lot compared to its friends in this basket, but Gemini and their AI and where they're moving looks really sound. Walmart, which explains consumer staples. Meta, maybe the torture's over. And you still have gas on Lilly, Nvidia, Amazon, and there's your Tesla. And there's a lot of pain. Luckily, the pain in Microsoft is slowing down today, which is really nice. But pain in Microsoft, Oracle, Berkshire, Visa, there's a lot going on there.
Let's go to the ranks. Let's go to the ranks. We'll hit those real quick and then go to questions.
Okay, I'll start with ETF ranks since we've been doing a lot of ETF talk so
Yeah.
far today. So again, this is in the members area. You go to the live sheet. Actually, let's do it right here. So you're in the hub, live sheet, and the ETF rank is right over here. And this is what it looks like. And you scroll down. There's a lot on here, but I think it's interesting that you now have a lot of overheats, 26 out of roughly 90. There's your value global. So talk about the Venn diagram. It's international plus value. These are like, if you think about this as like the Case-Shiller really inexpensive valuation stock markets. So that's Cambria's ETF. It's interesting. Then you have a whole bunch of metals and miners and metals and miners and metals and miners and energy. We added Brazil earlier this week. So far, so good. There's your small caps. We talked silver's been dynamite, clean energy, flat day to day. Any thoughts on the rank or anything stand out to you, Mike?
The only thing I'll throw out is it's fascinating. If you go up to the upper right-hand corner, we always like to take a quick look at the signal summary. And you've got literally only 11 break signals on this list. And this includes the inverse. We include three inverse ETFs on this, and that includes that. So including those, you got 11 breaks. So it tells you the wide breadth of what's happening here with this ETF basket. It's actually not, you showed that. Look at where the S&P 500 and the Qs are falling down the list.
Yeah, you're at the bottom. If you keep going down, you got Bitcoin down here, you have financials, you have cloud computing, cybersecurity. So these are the getting disrupted by AI according to where dollars are shifting. And I always think there's so many investors who just love individual stocks, and there's nothing wrong with that. There's massive opportunity in individual stocks, but there's a lot of exciting opportunities in ETFs. Look at some of these, like 40, 30, 26. Today's day 23 of 2026, and there's some real explosive baskets of either stocks or commodities. It's pretty interesting. I'm going to move over to the billion dollar fund manager stock rank. So again, we cut and clean every month, about $1 trillion. We cut it for growth and liquidity, and it leads to some pretty exciting tickers. It saves us a ton of time. I hope it helps you. Mike, what stands out to you?
Just I'll make a broad comment and then I'll make a specific stock comment. Broad comment is similar type of thing.
Oh,
Out of roughly 90 ticker stocks, you got 17 breaks. So it's very interesting, kind of shows the strength of what's going on, especially with this list. Specifically on the ticker that jumps out at me is Intel. As of us having this video, 16.6% down. This kind of just, it's a great example to me of why position sizing is so key in whatever process you follow, whether you're doing investment rules, following along with us, or you've got your own process. Position sizing is key because if you, for example, had a five ticker stock portfolio, One of them was Intel. You're riding that trend and it's down 16.6%. That's a kind of a punch. So anyway, just a quick thought.
No bueno. Yeah, I would say things that stick out to me are there's some really great merchandise in here. Intel was an overheat to a gas and it had earnings. So if your process says don't buy right before earnings, or if your process says don't buy overheats, that could have been helped. But if you think about it, the market's up, what, 1% year to date, and
Yep.
it's already still up 22 despite today's mess. So that's pretty impressive. So there's a lot of great merchandise. So you have the ETF list, you have the billion-dollar fund manager list, and then that drives the
Watch list. I think I made a comment last week that the way our new setup is for 2026, that it's a really quick way to kind of look at what's going on in the market and strength, where we're putting up 20 ideas and I'm looking at two things each morning. I'm looking at, do we have a full list of 20 or is it down to 15 or 12 or whatever? That kind of tells you like there are less fish in the pond, so to speak, when it's down below 20. But also, I'm looking at overlap. And the quick way to look at overlap with our current ideas is in the columns that say add date, add price. It's a really quick way to say, okay, are these tickers in the model portfolio and are they potentially actionable depending on your process? Yeah, that's any kind of anything jump out at you, Scott?
I think that's helpful. So this list can move throughout the day. We do a
Right.
refresh as well. And then at the end of the day, all the ranks and re-ranks are done. So that's all fresh data. And the hope is to really, for us personally and for you, is to save you time. So if you don't have any metals, again, we'd always make sure your position sizing is appropriate for your risk tolerance, but palladium's at the top. It's gone up a lot, but it could potentially go up a lot more. XOP, which is the oil service companies, which bottomed last summer, so way before headline news in Venezuela. You have small caps, which we added to. Corteva is fertilizer, Valero, semiconductors. So it's so interesting that this list will be really helpful that there's still strength in commodities, there's still strength in semiconductors. The software names have been kicked in the shins, they won't show up here. And this is that extra layer of confirmation where you're still going to see some explosive things.
Scott, anything to add to that before we close it out?
Markets rotate, and we will rotate as well.
Yeah.
And I think you've just seen an example of most people are in the S&P 500, which is the Magnificent Seven, which are underperforming, and most people are in diversified pie charts and they don't own gold, they don't own precious metals, and it was too long ago to remember the lost decade of 70s when commodities went phenomenally well. And the last time they did this was 2011. So the human mind has an incredible way of forgetting how good it can be and how short people are and how short covering can be pretty explosive. And that's what's happening. So markets will rotate, we'll manage risk. I know right now our risk beta to the market is pretty low, but our overall risk is high because it just keeps ripping, and that will tighten up too. So the answer is we will try our hardest to deliver good information that we will happily use for ourselves, our families, our clients, and for you. Thank you so much for being here. Thank you for your time. I hope this helped you identify some uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com.